Hey everyone, welcome to the KE Report in a daily editorial on Thursday, May 8th, chatting with Brien Lundin, editor of the Gold Newsletter, also our host of the New Orleans Investment Conference this year, November 2nd to 5th. We'll chat gold as we usually do with Brien, and today, Brien, not the best day for gold. Gold continues to be volatile, but we have seen some selling pressure come in today with gold on the futures market down right around $80, still just marginally above that $3,300 level. So again, gold just in a way maybe consolidating in around this range of about 3250 up to almost 3500. Look, the sell-off today seems like it's a lot around some potential U.S. UK trade deal. Markets, again, just trade off of, I guess, any news out of the White House. One thing that really stands out to me is really the inverse correlation of gold to the US markets and even gold stocks to the US markets. Brien, in your eyes, what's standing out to you about gold, how it's performing compared to a lot of other financial assets around the world?
Yeah, thanks, Corey. I think that's the key. I think you nailed it, that the correlation, the inverse correlation with the US stock market is kind of maintained, at least today, and here and there in spurts in recent sessions, because gold has emerged as the preeminent safe haven. It is the risk on investment. And that's all part and parcel of that selling America trend that's developed over the past few months, and it really accelerated over the past few months, and that central banks, nation states, official buying of gold to gain independence from the dollar hegemony. That really started in 2022 with Russia's invasion of Ukraine, but it really accelerated over the past year or so with, more sanctions, a lack of faith in the dollar, and especially over the past few months with the trade war. And so I fully expect that if we continue to see some progress on the trade agreements, if peace and tranquility break out, which it always does in the end, I fully expect that will be negative for gold, and that will kind of prolong a correction in gold. Not necessarily because of a lack of international or lack of central bank buying, but because the speculators are going to jump on it from a short standpoint, feeling that was the main driver for gold, when in fact it really hasn't been and won't be over the longer term.
Well, Brien, just to that point, even if the speculators do jump on the short side, is it possible that they're going to get wrong-footed with so many banks and financial institutions looking at higher targets just for this year, 3,500, 3,700, even 4,000 calls from financial institutions that have been traditionally not interested in gold? And so when you're seeing that kind of bigger money looking at higher price targets, is it possible that a lot of people that think the rally maybe was over and 3,500 was the top are going to get wrong-footed on this trade?
Well, I think it's really herd mentality at work. All of the big banks and institutions raising their targets for gold. Why didn't they have those targets a year ago? Because they see the trend and they're jumping on the bandwagon, and the bandwagon, at least temporarily, is getting a bit crowded. If gold has a longer term correction, then you'll see those banks bring their prices down. It's just, herd mentality. They have no conviction. They're just trying to project trends. And traders are of course, looking for the short-term trading opportunities. The key thing to me over recent weeks, and fair to say, not necessarily over the last few days, but over recent weeks, is that this kind of strong undercurrent of official buying, most likely from China, and including Chinese investors, has really helped propel gold. And if you look at the longer term picture over this entire bull market, which has been like 14 months long, it's been different than any other bull market out there that we've ever experienced before. And I put a piece out on this actually yesterday, that there are a number of unique characteristics about this bull market. Things like, the mining stocks haven't participated or haven't leveraged, silver hasn't leveraged, The Western investors have been largely absent, and the corrections, other than the post-U.S. election correction in November, the corrections that we've seen in gold have never gone as deep or as long as we would expect in a typical market environment. And the reason for that, I believe, is that because so much of this buying has come from official sources. It's not been so much driven by the ebbs and flows and swings in investor emotions that we would typically see in any kind of a investment trend, but rather by geopolitical strategy. And it's been fueled by the deepest pockets imaginable, nation states and central banks. And that's the underlying, one of the underlying trends that has been driving this market. I think any absence of that is only temporary. And I think we have seen apparently over the last few days a bit of a break in that it seems like the Western speculators have seized, at least temporarily, control back of the gold market.
Brian, I think that's kind of the biggest change, though, right? I think from the last year, to your point about why banks didn't have higher targets for gold, I think a lot has changed over the last year. And that is why we're seeing more inflows into the ETFs from Western investors and this whole sell America trend. I know that it was being talked about and there was data around money exiting the US bond market, but it's really picked up steam. And there is this anti-US sentiment around the world. Hence why we're seeing a lower dollar, lower US markets, and gold really benefiting from it all. But again, this is just happened really this year. Ever since Trump got into office, this seemed to have kicked into high gear on the back of all these trade fears. Even the Fed seems like they're handcuffed. They don't know what to do because no one can forecast what is coming next in terms of tariffs, in terms of trade agreements. What do you see on the horizon that can change this overall sentiment? Or, quite frankly, are we in this new financial world where America, as the leader in the financial markets, just isn't going to stand any longer?
Yeah, it's been interesting. In other periods of geopolitical and economic uncertainty, America has stood as the leader and to some degree the potential savior of the situation, whatever it may be. In contrast, throughout this trade war, America has not been viewed as that. It's been viewed more as the instigator and even the adversary of nations. I do believe that's temporary, though. I think we're going to see these trade deals for a number of reasons because, the Trump administration likes this kind of brinkmanship. They like to make things very desperate seeming and out of control, and then they pull back and they use that as leverage to get a deal. I think that's going to happen because it has to. They're not going to want to bring on a recession. They may be too late to prevent it, but they don't want a recession. They don't want inflation and everything that their strategy will bring. So they will pull back. And we saw today, the announcement of a deal with the UK. So that's going to be the start, I think, of a trend. I don't think that's going to upset the longer term trend of central banks continuing to accumulate gold as reserves vis-a-vis the dollar especially. And the ultimate trend, which is the fact that debt loads are too large at this point to have anything else but lower interest rates and declining interest rates and lower real rates of interest and negative real rates of interest. So we're going to see that regardless. And I think that's the ultimate driver of the monetary metals and commodities in general.
Well, Brian, if we filter the conversation over into the equities that we follow, and you mentioned that, the gold stocks haven't really leveraged the moves like people would have expected. Same thing with silver and some of the silver stocks. But if we just isolate it to the gold stocks and we think about the numbers we've been seeing over the last couple of weeks from Q1 earnings and what we saw in Q4 earnings, frankly, and even Q3 earnings before that, we're seeing a trend higher and higher. So far in Q2, we have to say that the gold price is even higher than Q1. So unless something drastically falls apart the second half of this quarter, it looks like Q2 is even going to be better. are those earnings reports becoming so big compared to a lot of other sectors that even generalists that don't know how to spell gold can't help but at least look at the earnings potential from the sector?
Yeah, they have to. That's the fundamentals that they would look at. But they're also looking at the performance tables. The first quarter, gold beat every other asset class except one, mining stocks. So the rise in gold helped fuel at least some level of enthusiasm from Western investors for the physical metal. We saw that the flows into GLD went significantly positive over that quarter as gold continued to perform. Now we're starting to see that performance in the mining stocks. In fact, in the first quarter, the gold went up about 16%, and the mining stocks essentially doubled that, according to the major indices. So you get that first quarter report card, and any institution or hedge fund that is not reporting a position in the top returning asset class in the world, will have some explaining to do. So we started to see these flows into the metals and the miners toward the end of the quarter and post those first quarter reports. We're seeing now over, say, the last week is only kind of a counter trend for that. Now, that said, too, Monday and Tuesday, we had $200 days in gold in succession. So, it's easy to ride these emotional roller coasters with gold, where your feeling on the metal is dictated by what it's doing today. The longer term is still spectacular, has been spectacular for the metal. And I think we're going to get back on track very shortly.
Brian, you are right, though. The stocks have done quite well, especially the miners. Most of the miners, even small scale miners, have leveraged that move in the gold price. But a lot of people are complaining it hasn't gone down to the development companies, hasn't gone down to the explorers. I do see that argument. The problem I see is that there are still too many development plays out there, and development plays don't make money at this current gold price until they're built. So these assets need to get built to take advantage of this higher gold price. Yes, it might keep going higher, but that is the risk that investors would have to take is if you buy the development plays, how long does it take to build them? So when you're looking further down the food chain, what are you looking for in that sea of stocks that hasn't benefited to the same extent that actual mining companies have?
Yeah, now that the Western markets are starting to focus on the gold producers, you're going to have all of these analysts and these major banks examining the gold sector and gold producers with a fine-tooth comb and trying to find differentiating factors. They're going to look at reserve replacement, that pipeline is one of the key differentiating factors. So these companies are going to have to get their houses in order in that respect. And the ones that are more aggressive in buying the better projects are going to look much better, and they're going to be rewarded in their share price. So in that regard, I think there's a number of developers, explorers out there that have very large resources that are going to be first on the shopping list, at the top of the shopping list. And that's where I think it's going to move first. And, we are really victims of a long bull market in small-minded thinking in the mining sector. When you think that the kinds of money that's thrown around in these broader markets when a theme catches hold, when you just look at the billions that's being wasted in government, that Doge is turning up. $1 billion here, $1 billion there, focused on the mining sector would have tremendous implications for projects and companies and valuations. And as this sector continues to perform, it will eventually attract that kind of attention.
Yeah, the problem too with building some of these mines is it's still the government's problem and permitting and all these other issues that go along with building these assets, which is sometimes why I think we don't see the capital flows coming into these development plays. But Brian, right now, one thing that is underway is drill season. A lot of drilling that's going on by a lot of exploration companies, also a lot of development companies. We haven't seen this much drilling planned and on tap in years. So there's going to be a lot of news coming out in the later half of the year. What are you going to be watching for out of this year's drill season? Anything in particular?
Yeah, lots of news. A lot of really great projects have been just sitting in the starting blocks. Some of them have had some great drill results, but companies have been capital constrained. They really haven't been able to get the work done that they've needed. Now companies are being able to raise money, significant funds, and they're putting those funds to work. Right now, we're starting to see a lot of drill results. I've been very impressed with some of the results that have come out over the past month or so, and that's just going to accelerate. If there's one play that I would love to try and get involved in are drill companies coming up, because there's a whole lot more money involved. Drills are going to be at a premium and hard to find. I think we're going to continue to see, and there are going to be some really high profile projects that are following up on last year's discoveries. So it's going to be really an exciting drill season, exciting exploration season, and lots of opportunity. But that window, if you're looking ahead, that window is closing right now. We're going to see over the next month or so company valuations, share prices start to rise as we anticipate the drill results in the summer.
Yeah, it's very true. We'll see how the market even takes these drill results, but there is going to be a lot of news on the drilling front. And hey, hopefully there's still a market at the end of this year to fund these companies moving forward, because there's going to be a lot of money spent. And I think all investors want to see some results that are rewarded by the market, which the market has been rewarding some companies, but still very selective in the exploration game. Brien, it's great chatting with you. We'll wrap it up here. Again, Brien Lundin is the editor of the Gold Newsletter and our host down at the New Orleans Investment Conference this year, November 2nd to 5th. Brien, I'll see you down at your conference, and we'll be chatting in the next couple weeks. So thanks for your time today. Have a great rest of your week.
Thanks so much, Corey.